Welcome, and thanks for joining me today on Mortgage Manager Playbook, a podcast for sales leaders who want to improve their team's sales performance and originate more loans. I'm Pat Sherlock, your host. Today we're going to take a deeper dive in taking our forecasting and looking at to our financial service industry, particularly the mortgage industry, for the next 3 to 5 years. And I have the perfect expert, Rick Sharga. He is well known. He's on TV talking about the market. He's an economist. He has a wonderful consulting firm called CJ Patrick, and he certainly is in the fintech. He's been on the mortgage side. Rick, I'm running out of compliments. You're in the 100 most influential people on Inman. So I'm thrilled to hear your thoughts about our wonderful world of financial services and all the changes that are going on and how you see this playing out. So let's start with the easy question. How do you think the next 3 to 5 years, besides less competition, is going to play out?
Oh, well, thank you for having me, and it's nice to be here, and I hope I can live up to that introduction. Yeah, the next 3 to 5 years are going to be challenging for the mortgage industry. It's very likely that we're going to see another few years at least of relatively low home sales and a lot of competition for the purchase loan activity that's out there. And until we start to see mortgage rates come down, we're probably not going to see much in the way of a refi market. For what it's worth, I don't believe we're likely to see a home price crash, which is good news for lenders, particularly those with large servicing portfolios. But I do think if you go back to the 80s and 90s, there are probably similar cycles where there's been some sort of economic shock. In this case, it was a doubling of mortgage rates. And instead of a crash, what you saw in both cases was a 2 to 4 year period where it was just a boring housing market. You saw sales go up marginally, you saw prices go up and down within a fairly tight band. And I think that's really what the mortgage companies are in store for the next couple of years. I do have some concerns about overreach by the regulators. There's been some recent noise coming out of DC about the need for more oversight and more regulatory compliance for servicers, and particularly those for non-bank servicers. And I'm a little bit concerned that we might see steps taken that inadvertently wind up putting too much stress on that part of the market. But long answer, sorry, to a short question, but I think it's going to be a tough few years for the mortgage industry while the market kind of slogs through this transition.
Well, I'm interested, Rick, on your thoughts on, especially on, since you've been involved with the fintech world, and certainly when you look at the mortgage world and mortgage lenders, the technology usage has actually, they've invested millions and actually lots more than that on investing in new technology, but it hasn't really played. The cost of production obviously is sky high. A large part of that on the sales side is roughly based on base compensation. And so, how do you see all this playing out? They always talk about innovation, but it doesn't seem to actually translate into much.
I'm chuckling because in a past life, I remember seeing advertising from a company that said innovation is our plan for tomorrow. And I thought they have no idea how bad that line really was. Yeah, the mortgage industry has spent a ton of money on the front end of their systems. And I think you can either blame or give credit to Rocket Mortgage back at the time for making the digital front end really kind of the table stakes for mortgage companies in the business. And after Rocket launched, so to speak, we've had all of the other mortgage companies kind of fall in line. You saw third-party vendors like Blend come into the space.
Right.
And everybody really focused on having that digital front end. It became a little bit of a me too, but if you didn't have it, it was noticeable. And with millennials and Gen Z borrowers going to be the bulk of the folks taking out loans going forward, you needed that technology. What we haven't seen is similar progress in the back end, the plumbing, if you will. And so I think we're probably going to talk about AI as we go forward a little bit in today's conversation. But the platforms, the loan origination platforms, the servicing platforms that are out there are decades old technology. I kid people that the good news is hackers can't break into them because none of them know how to do COBOL programming. So I do think we're going to see some technology work its way into the system. We're starting to see some new players coming into the market, whether it's companies like Sagent who are kind of reinventing their platform,
Hmm.
or it's
Hmm.
companies like Accelerus or Aspen Grove that are coming in with completely new systems. But it's very difficult for these lenders to migrate from an
Hmm.
existing system to a new system.
Hmm.
And the companies that have provided these legacy systems, for whatever reason, haven't been in a hurry to update them. So it's a little bit difficult. And now the challenge that these companies have is it's tough to invest millions of dollars during a period where your loan volume is historically low. So,
Hmm.
it's kind of a double-edged sword in this market, Pat. When business is really good,
Yeah.
you're too busy to change your platform. And when business is bad, you're not making enough money to change your platform. So I guess we're waiting for that Goldilocks period when there's just enough business that you're able to invest, but not disrupt things. And I guess for a lot of lenders, we're not there right now.
Well, I had Strathmore on for a session, and they talked about that their comment had to do with, in particular, about the sales compensation side of it, and that it's still roughly, essentially almost greater than 50% of the cost of the lenders. And as a result, this dependence on, in essence, the human loan officer and recruiting them and supporting them has translated into really lenders not making money. My question to Strathmore is why haven't, especially in pain, why haven't lenders made a bigger leap into actually kind of addressing some of the things you're talking about?
There are a couple of reasons. One is it's the we've always done it that way syndrome.
Sure.
The other is, candidly, a good loan officer historically has kind of paid for him or herself.
Right.
And so a lender tends to go to that loan officer who's either really good at prospecting or has an enormous database of contacts that he can get leads from, or is just really good at closing. And so you're willing to pay. And this, by the way, is not peculiar to the mortgage industry. This
Sure.
you
Hmm.
you you know sales, so this is
Sure.
true for any industry. You tend to pay more to the salesperson who earns their keep, and so sales managers very often make less than their best salespeople, and are okay with that because of the amount of volume a salesperson brings in. I think where you could see some change going forward is if we provide better tools, better technology that minimizes the reliance you have on that individual to be able to prospect, secure, and
Hmm.
close the deal. The more of that you can automate or use
Hmm.
technology for, the less reliant you are and the less you're likely to have to overpay. And that's again not diminishing the value these salespeople bring to the party,
Sure.
but the reality is that in a lot of ways, again, we're still dealing with kind of antiquated processes and systems
Hmm.
that very, very heavily rely on that human interface.
Well, that raises the questions, and one of my favorite topics have to do with banks. The banks and certainly the depositories have the opportunity to actually tap into their database and use that as a selling vehicle. I rarely see banks actually doing that. They talk about it, but doing it is another thing. And it leads itself to really not recognizing that the mortgage product is kind of the first step into the world of bringing more deposits into your company and so forth. So what do you see in that, and why haven't banks really made the investment to actually use their own database?
I think you and I should probably go off on a retreat somewhere and write this all up, and we can we can
Yes.
we can sell the real answer and retire on some secluded island in the Caribbean. It's an age-old question, and
Right.
at the risk of overgeneralizing drastically, fact is historically banks haven't been very good at marketing, period, full stop.
Right.
And as evidence of that, look at the mortgage business. The most recent numbers I've seen came out at the end of 2022, and they show that about two-thirds of all mortgage originations
Hmm.
were from non-bank lenders. That's up over the last decade from, less than 30% to now almost 70% of the mortgage
Right.
business going to companies that are not banks, who are much better at marketing, either going direct to consumer or marketing through other channels. The banks have had that huge advantage
Mm-hmm.
in terms
Mm-hmm.
of having that
Mm-hmm.
database of prospects and customers and have not leveraged it for one reason or another. But I think part of it too, to be honest, is that a lot of the major depository institutions are still kind of licking their wounds from the Great
Right.
Recession and have kind of backed out of the mortgage business. If
Right.
they're in the mortgage business, in a lot of cases, they're doing wholesale lines for other lenders or they're
Mm-hmm.
buying loans on the secondary market, but they have consciously decided to step back from the mortgage industry because either of the risk or because of over regulation by government regulators or headline risk if they ever have to foreclose on somebody, God forbid. So it's partly by design and partly because candidly they're just not as good at doing some of that marketing as some of their more nimble competitors are.
Well, it's interesting you say that because one of my big peeves, I guess, is to talk about the world of that I do see with financial institutions, particularly depositories, that they really don't value selling. They talk about selling,
Yeah.
and they certainly have wonderful logos and certainly brand commercials that say that. But then in the real world, you end up calling a telephone tree. You never get to talk to anybody, and this whole litany. So from that standpoint, do you really see banks kind of making, will they ever change that dynamic where we're talking about that this becomes a much more important product for them than it has been?
I don't think in the current market environment,
Mm-hmm.
which is very competitive, you're going to see the banks claim a higher share of market than what we've been seeing over the last few years. If you want an example of a product that typically has been owned by depositories,
Sure.
look at the home equity lines of credit,
Mm-hmm.
HELOCs. And historically, that's been a product that depositories have
Mm-hmm.
have owned. If you look at the top 100 issuers of home equity lines of credit today, what you're going to find is it's almost entirely credit unions and local and community banks,
Right.
small banks, not the Wells Fargos and the cities of the world, but your regionals and
Mm-hmm.
locals. And that's because those smaller lenders, smaller financial institutions have ongoing relationships with their customers, or as credit unions will tell you, their members. Whereas I don't think the bigger depositories have ever cracked that code, except when it comes to particularly high net worth individuals. And
Right.
and so we have seen the Wells and the B of A's and the Chases, in particular over the last few years, kind of double down on jumbo loan products and keep those loans on their books in their portfolios because even if they're losing money on the mortgage, they're making money they believe by being able to sell those high net worth individuals other products. And so it's a different market than it's been historically, where again, something like a mortgage, if you're losing money on every one you issue today,
Mm-hmm.
you're really not all that motivated to go out and sell more. And a lot of the bigger banks find themselves in that situation.
Well, that's certainly true. And I agree with you. It doesn't look like to me, and I'm interested in your thoughts, that it does seem to me the viability of the independent mortgage bankers is certainly still going to be there if you're looking at, 3 to 5, 10 years down the road for all the reasons you just talked about.
The issue, the mortgages that the bigger banks are issuing right now,
Hmm.
all tend to be conforming loans,
Right.
30-year fixed rate loans that they can
Hmm.
then sell off to Fannie or Freddie. And by definition, that limits the number of loans you can sell. It's still the
Sure.
most popular loan, but the other part of that is you're kind of limited in how you compete there because it's pretty much a homogeneous product.
Right.
So are your processes a little bit more customer friendly? Are you marketing a little bit better? Are you competing on rates? It's kind of
Hmm.
speeds and feeds, right? And again, you're working for a big bank. You're probably not quite as nimble as a Rocket or a Loan Depot or
Hmm.
a New American Funding or some other independent lender who really makes their bread and butter on these loans. But the other thing that those independent mortgage banks have, and I think keeps them in the game for the foreseeable future, for the indefinite future, is they're much more able to adapt to different market conditions and
Hmm.
frankly, different markets. The borrower of the future is going to look and sound a whole lot different than the borrower of the
Right.
past. We're probably less than 20 years away from the majority of home buyers being minorities of some sort, whether
Hmm.
it's Hispanic or Asian or Black. We're seeing that model change over time. If you're an established lender, a depository bank, how are you going to relate to these changes? And people who like to do business with people who look and sound like themselves, where language isn't as much of a barrier, where culture isn't as much of a barrier. So
Hmm.
I think the smaller independent mortgage lenders are much more adaptable, much more likely to be able to adapt to those kind of changing social and market trends, and that keeps them in the game. And they also tend to offer a much wider range of
Hmm.
products, non-QM loans and loans that don't fit
Right.
precisely in that little conforming loan box. And a lot of them are much more dominant FHA lenders.
Right.
So that flexibility, that willingness to adapt, that essential ability to move as the market moves, I think really does play well to the benefit of the IMBs.
Well, when you think about it, when you look at also, Rick, is that, and this is kind of the big open question, is the sales model broken when in fact you can only make money on refinance markets and not in a self-sourcing purchase money market, which is really our model. And we have been saved over the years, certainly because of refinancing, but now we're back to the traditional model, and it doesn't seem to be working that well, especially when you look at the profitability of lenders.
Well, you're much more of an expert on the sales process than I am,
Yeah,
Pat, but
sure.
I will tell you that the loan processing itself has not been optimized for
Hmm.
purchase loans. And
Hmm.
I think to a certain extent, the industry probably got a little fat, dumb, and lazy during the period when mortgage rates were down in the twos and threes. And
Hmm.
all you basically had to do was throw your hand up and say, I'm here, and you'd get some business. The other reality, I think, and this is going to sound harsher than I mean it to, is that the industry probably hasn't downsized enough to
Right.
reflect current market volume. And because of that, you're trying to spread out too much overhead cost over a much lower volume of
Hmm.
loans.
Right.
It's not that a purchase loan in and of itself is an unprofitable product. It's that your organization is unprofitable because you haven't
Mhm.
adjusted the size of your operating structure. You haven't adjusted your expense structure to reflect the new world of the volume that you have available. And one of the interesting things from the Mortgage Bankers Association, Pat, is that if you look at
Hmm.
lenders in the mortgage space that are profitable, a
Hmm.
much higher percentage of the profitable lenders are the ones who have their own servicing. So,
Hmm.
and the ones without servicing are having a harder time being profitable just on the origination volume. It's the overall structure of the lending institution, I believe, more than it is necessarily just the sales process that becomes an issue.
Well, I think you're exactly right. And actually, data from Jeff Walton's Ingenious company, he's showing that the bottom 50%, and this is throughout the industry, are only generating 12% of essentially
Right.
production. And so it is a mystery of life that they did not actually downsize fast enough under, I guess, the hopes of a refinance market coming back or something like that. And it just seems is that we've seen this story before. So what have we
Well,
learned?
and what we haven't seen yet in
Hmm.
large numbers, but I think we will continue to see over the next couple of years is more and more contraction in the industry.
Sure.
We're seeing companies going out and either buying some of those smaller companies just to expand maybe their geographic
Hmm.
reach, or they're just absorbing these lenders, these institutions that have decided to shut their doors. So yeah, I'm not going to sell my company to you because I'm not making enough money for it to be an
Hmm.
attractive purchase. But why don't you just take on, parts of my staff, parts of my business and append them to yours? And I think we'll see more of that over the next few years. To your point,
Hmm.
if the bottom 50% are only doing 12% of the business, we know how that movie is going to end. And it's just a question of when.
So that raises the bigger question when you're looking, and I've heard many of your forecasts that are actually more accurate than what I see from some of the institutions that that's their job. And so when you look at the housing market itself, and I'm very much interested in you kind of talking about you see opportunities in local markets and kind of a strategy that's much different than like we're going to be everywhere, every place. So could you talk about that?
If you look at things that are going on, again, this is looking at
Hmm.
society, not necessarily looking at things that lenders
Hmm.
typically look at. We're seeing a lot of migration patterns that are very unusual in the country compared to what we've seen in the past. A
Hmm.
lot of people moving out of high price, high tax regions of the
Hmm.
country
Hmm.
because they can't afford to buy a house there, and
Hmm.
they'd like to be homeowners. Job mobility has made a big difference there. So when I'm talking to either lenders or even real estate investors, I tend to tell them the same thing: follow the population. Where you see
Hmm.
population growth happening, where you see job growth and wage growth happening, you're very likely to see a pretty strong real estate market, whether that's rental properties or home sales. And you're seeing builders actually follow those trends as well. And a lot of the new construction is taking place in those markets. So there's an old joke that Sam Kinison, the late comic, used to talk about in Africa. He said, go where the food is. And I look at the same thing here: go where the people are, go where the jobs are, and you see those things moving. I tell the story anecdotally. I have an adult son living at home. He's getting married in September. He's a teacher. His wife to be is an attorney. And they came to me a couple of weeks ago and sat me down and said, "Hey, you do this for a living. What states should we be looking at to move to so we can eventually own a house?" Because the median price of a home being sold in California right now is about $800,000. And they know that's not a good place for a first-time home buyer to shop. So I think that conversation is going on in a lot of households down the
Mm-hmm.
California coast, Pacific Northwest,
Hmm.
markets like Austin and New York and Chicago and Miami, and people are moving where they can afford to buy.
So when you look at this issue of affordability, obviously it comes back to down payment. And so with the housing values high, then you're talking about obviously the amount has to be saved is certainly not in proportion. I mean, in
Yeah.
other words, with people's income. So how do you see this playing out?
Again, if you go to YouTube, you'll see dozens and dozens of people breathlessly talking about the coming home price crash
Right.
because of affordability issues, and there's just
Hmm.
nothing in the data that suggests that. We still have more demand than supply. We have another 2 or 3 years where we're going to have record numbers of people getting to prime home buying age, prime household formation age. So
Hmm.
demographics weigh very strongly in favor of a continuing strength of demand in the housing market. I think it will take a few years for things to normalize. Again, I
Hmm.
think we saw home prices spike when mortgage rates dipped, and
Hmm.
I think that pulled forward a lot of demand that would have been happening now or
Hmm.
a year from now when people jump to take advantage of those low mortgage rates. I think it's just going to take time, Pat. I think we are going to continue to see people move away from those higher priced areas. The people that are moving into those high priced areas tend not to be first time home buyers. They're people who have accumulated equity in their current
Right.
property and are leveraging all that equity to make a pretty hefty down payment. One of the things we didn't talk about but that is a concern of mine, and it's related to your down payment question, is what's going on with compensation in the realtor community, and the fact that we're now decoupling buyer's agent compensation
Right.
from listing agent compensation. That may eventually be a good thing for home buyers and home sellers. My fear is that right now, what it's going to do is put even more of a financial burden on home buyers. In the
Hmm.
past, you were technically you were financing the buyer's agent
Right.
compensation
Hmm.
because you were getting the loan and the funds were coming out of the loan. You're not allowed to finance a buyer's agent fee according to today's mortgage rules, but you're going to have to pay them somehow. And if you can't get the seller to do that for you,
Hmm.
you're going to have to come out of pocket. So now home prices are at almost an all-time high.
Right.
Mortgage rates are double what they were a couple of years ago. You need
Hmm.
a lot of money for a down payment. And now you're going to be required to come out of pocket, pay your agent as well. Or worse, you're going to wind up going into a deal unrepresented, which is just nobody's idea of a good time. So I am a little bit concerned about buyers and the stress on
Hmm.
buyers in the next couple of years till this all gets settled out.
And I guess that ties together with the NARN settlement and what your thoughts on that. It obviously looks like that it's going to happen soon, although the date seems to be changing. But what are your thoughts on how that's going to play out for the real estate world?
I think you'll see a lot of attrition among
Hmm.
the rank and file in the realtor community. But to be honest, there frankly are too many real estate agents for the amount of volume we have. We sold 4 million existing homes last year. There were 1.6 million registered or licensed realtors.
Right. Hmm.
That's that's if everybody did deals, that'd be 2 deals per realtor a year, which, tough to make a living doing that in Nebraska.
Yeah.
So I think we're going to have some fallout there. I think we will see more informed consumers when it comes to what it costs to buy and sell a house. I do think ultimately the compensation for realtors in a given deal will come down. I wouldn't be surprised to see entirely new methods of compensation. For example, a realtor I was talking to came up with kind of a menu of tasks they could do. And they would do everything on the list for, a certain percentage of commission on the sale, or they would do this much for negotiating your contract. They would do this much for reviewing the disclosures. They would do this much for staging or for,
Mhm.
negotiating or whatever it might be. And I think we'll wind up seeing something like that. But in the interim, I'm afraid it's going to be kind of messy, and I'm not sure what advice to give buyers. But I do know I've talked to listing agents, dozens and dozens of listing agents who are basically having their sellers are telling them, this is what I'm going to pay, and I'm not doing anything to pay for the buyer's agent. So, they got to figure that out. So it's there's going to be a period of uncertainty and messiness for a while until we figure out what the new model is going to look like.
Well, I think that's a great point to end on because I have to have you come back. And so, a couple takeaways, Rick, for our listeners today that you would like to share.
Yeah, I think there's going to be, if you're looking for business, there's going to continue to be business out there. Most of it's going to be on the purchase side.
Hmm.
I think the point that Pat made earlier is worth hammering home. Your best customers are very often your current customers, and leverage that database that you have because that's your advantage. I think one of the biggest mistakes mortgage servicing companies have made over the decades is that they haven't figured out how to create a real relationship with the people they're collecting checks from every month.
Right.
But boy, there's an installed base of people that are credit worthy, that are making payments on time, probably have equity in their properties, and are opportunities for either a home equity line of credit, a home equity loan, or maybe a refinance or new purchase down the road. So pay attention to your current installed base and leverage them before you start spending a lot of money looking elsewhere.
Well, Rick, I have to thank you for spending your time today to share with all your wisdom. And how can people get a hold of you to talk to you about this?
You can certainly find me on LinkedIn and Twitter. I'm Rick Sharga at both, so I'm not too hard to find. You can check out my website, which is cjpatrick.com, and you can find me on really good podcasts like Pat's.
Well, I loved having you, and I have to have you come back. And I just think that you share such important information. I'll have to have you come back and do the Costco index the next time. So thanks so much, Rick.
Thank you.
Thanks for listening to Mortgage Manager Playbook. You can catch up on all our episodes by subscribing to receive each week a new show. Don't forget to share this podcast with your friends and team members. If you're looking to increase production, call me to discuss my prospecting sales training program, Ramping Up Realtor Referral Sources. Check out my website, www.patsherlock.com.